live. So welcome. Today I wanted to talk about something that I feel is extremely special right now in this economy that we live in. And I wanted to say, I'm not sure if you said the statistics that we sent out. It is projected that 76% of small businesses are looking to exit in the next 10 years. That's 76. Last stat that I saw was more than 23 million small businesses. I know that's going up because people are opening businesses because they don't trust the employment, they don't trust this and that. The coaching, the consulting business has been exploding. So we want to talk about something that I feel it's really important in this time and this economy right now. So today I want to talk to you about, what do you do or how do you get ready if this is going to happen? Like I can tell you for myself, I'm looking for an exit from my own business. And how I'm looking for my exit, I hope that my son will come in, and I'm still working on it. I'm still trying to get him to be a tax attorney or an estate attorney. So as soon as he is coming of age, I plan to give this to him. If he doesn't want to get the firm, I plan to exit by selling. And we just got an offer recently about, if we're looking to sell. So with all this in mind, I wanted to share with you, how much time do you need to prepare for a sale? So I see people coming up to me and everybody is saying that, no, I don't want to sell, but giving the right offer in your hand, the right letter of intent on your desk, on your table, people are ready to sell for the right price. So how can you make sure that you get the most out of your sale? So we're going to talk about a couple of different things. Now, you might or might not be familiar with valuations, but when you sell, you have to have a valuation of your company, right? And what does a valuation do? An valuation has different ways of looking how much is your company's worth, right? When you work with brokers, when you work with other people who are coming and assessing or they're helping you sell your business, they will probably have that valuation completed. And many of you who have been in this journey, or have been owning your business for quite some time, you might already have some valuation done on your business. Now, I see people all the time arguing, saying, you know what, I had this valuation, but the numbers don't seem right. The numbers don't look right. Whatever approach they used, it doesn't look right. So you have to do some things on your books, on your financial, all your financial numbers or data that you have to really get you ready for that. So today we're going to talk about a couple of different things that I know it's a heavy subject, but I just want you to hear me. If you build anything that's worth selling, right? If you're building anything that doesn't involve you doing the work, this might be of interest to you, right? What do I mean by that? So if you're a consultant, and let's say you're a physical therapist, okay? And you as a physical therapist, you go in and what you do is you go in and do the work. You don't have anyone else working. You don't build a system. This is not for you. So evaluation or an exit by sale is for someone who builds something that creates a process. So if you're doing every single piece of the business, that means you can't sell. And I know it sounds hard. Listen, I'm trying to build processes for so long, and I still do a lot of it. I wish I would be out of the business, but I'm still working on the processes. And in small business world, we all work on the processes continuously. So with that in mind is, I want you to look at, what does it mean, right? Can I really sell what I have? Well, if you plan it, you might. Okay. There's other people that are starting out, that are buying their way into your industry, into your niche, into your space by buying someone else's know-how, right? Like people retire all the time, people die all the time, people get out of industries all the time. And with that comes the sale of business. Now, the majority of small private firms are being sold at asset sales, okay? Which is not true when you go to mid-market, and they're not the same. So an asset sale is basically looking at what do you have, in your business, what you've built, and someone is coming and paying for your assets. Now, a couple of pieces that I want to mention in the calculation here are the assets the asset sale will only include your inventories, your supplies, your fixed assets, all the intangible assets, right? It doesn't look at the liquid financial assets and all the liabilities. It doesn't look at that. The buyer that buys your company will get a brand new entity. You're not selling your name. You're not selling anything of that nature. So if you're looking to sell your name, you have a trademark, you have copyrights, you're looking as not an asset sale, you're looking at equity sale. An equity sale is really different. Why? Because this includes the asset, all the ones that we've just listed, but then you include the liquid financial assets, right? Less liability, right? It's the transfer of legal entity, the activity that you have, the account balances, the tax attributes, everything that you've got gets moved into a new entity. So with that, in mind, is it beneficial to have an equity sale or an asset sale? Now, many times, for us, we want the asset sale, in the small business world, because it's really beneficial to us and we can allocate the price to different assets, and the buyer just picks it up exactly the same way. It's easier to dissolve. It's easier to get out of a small business. But I want to point a couple of things. Now, when you look at a sale, there are a couple of approaches that people do on valuation. And I want you to, if you're in that process, if you're looking, hey, if I'm ready to sell, like, they have approaches, and we're not going to go into this because it's a little bit, it's more complex and we don't want to take the time on that. But I want you to really look at, how are you compared to the industry you're in? Like, what is the industry standard for what you're doing right now? And then once we have the industry standards, we have to have some benchmarks, right? How do we compare? Because that's really going to dictate the price that we can get for our entity. So with that being said, right? Let's say we define, we're in, what space are we in? Are we in real estate? Are we in manufacturing? Are we in consulting? Right? Are we an IT company? Right? What are we? And what's the benchmark for, that specific niche? If it's, we're doing only cybersecurity, or we're doing all the admin networking, right? So all these pieces are important. When we go and we found the benchmarks, then we have to figure out the KPIs, and we get to the juice, which is really, this really gets me excited, right? Now we get to the KPIs, right? Because when we look at the KPIs, we need to know how we measure against these entities in our market, right? And what are KPIs, right? So in the KPIs, we look at a couple of different things, right? Everybody looks at revenue, which are the basic ones, right? Which is the summary of your financials. You look at revenue compared to the other ones for the size. You look at pre-tax income. You look at how much you pay for your officers, how much, non-cash, one-time expenses, all these things, right? And we'll look at, one of the first ones that I want to take a look at is cash flow to revenue. Okay. And cash flow to revenue is really important because it really determines how well we are able to generate the revenue. How well are we operating on this? So when you look at different entities, how can we find the KPIs? There's several different resources that actually publish the KPIs for different entities, right? So, if you need more help or you have more questions on how do I find the KPIs, send me a private message or a comment below, and we'll go into diving into the KPIs, right? This is really important, right? Then the receivables. Right now, conversion is really, really hard. In some instances, people lag the payouts, and the receivables over time is really important. Is it how many days? Is it average for the industry? 12 days? How many days is average for our industry? Is it, prepaid? And we're charging 30 days, 60 days, 6 months later. Really important. This is going to help you. So working through the KPIs, working through all this, this little items will help us outperform in our industry, right? And what does it mean, right? The time, the lapse of time between, the issuing the invoice to collection. So the other, like, we're not going to talk about inventory and fixed assets because not all of you have that. But the other piece is debt to equity. This is important because why? A lot of people right now took a lot of loans. We got the EIDL loans out, right? So, if we are at 125%, what does that mean? It means the solvency ratio, right? It shows that the capital structure, right? All the assets might be financed by either debt or equity. So the assets that we have are financed by equity, by debt. that means we have no equity in the company. So if we function at debt to equity at 125%, there's no way we would be an industry average. We were going to be underperforming, right? So if you're low, if you take out loans right now, and I'm like, listen, I was a proponent. I said, take the loans out. It doesn't mean you have to use them, but see if you can use them to grow the business, to actually have more revenue, more income, from investing in equipment, in labor, in people, right, in culture, whatever you need to grow your business. Now, debt to equity is extremely, extremely overlooked. And I see a lot of people right now that are running, there's not negative, but we're above 100%. That means all our assets are being funded by debt, not by equity. So this is a number that I really encourage you to really pay attention. And again, there's so much out there about every single one of these KPIs. I'm just talking about the ones that are going to be important when you sell. Now, I'm not talking about the KPIs you need to grow your business right now. It's for a sell, right? So debt to equity is always important because no one wants to buy something there's no equity in it. If you buy a company and it's all leveraged by debt and there's really no solvency, there's no equity, like you get zero. I have talked to different types of small business owners, and someone told me recently that they got offered something that they would not even pay us for the company. They'll take the company over, and they will just offer you a job to stay in the new company, and they will pay you a salary, but there is no money. There's no value to the company for them to come and take it over. So they're doing you a favor, taking your company over. They're saving you because you have no solvency in your own company. So really be mindful. This is probably one of the top items that I would say right now in this current economy, when everybody's leveraged and over leveraged, with a lot of debt. This is important for you to take a look at. So please take a moment, take a look. These are just a few. Listen, we can go over and over and over, like interest coverage, right? We can take a look at, cash to debt. We can look at so many different pieces. I'm going to list a few of them, right? The income to revenue, the pre-tax, right? We're not even talking about, the tax implications. We're not talking about tax. This is just a few items that are getting our minds ready to be in the place where when the time comes, when I have a letter of intent, I am ready to get the top dollar for my company. So I hope this is opening up your mind, right? To see, I need to look and I need to prepare. If there's a chance for me to be able to sell this enterprise that I'm building, even if it's like 3 to 5 years out, I want to look at these items. I want to look cash flow to revenue, right? I want to look at inventory, if you really have inventory, fixed assets, if you have fixed assets, total debt to income. Again, that is another relationship of, the obligation, right? That you have compared to your revenue and ongoing profit performance. Really, it's important. So all of these pieces are crucial. If you want to have a more, in-depth conversation about the KPIs they need to track in your business, send me a message, send me a private message, send a comment below. I'd love to chat with you. What is important for your industry, right? What are the KPIs that you need to look at if you are looking to sell in the next 3 to 5 years, 7 years, right? How soon can you improve this KPI? Sometimes you need to work for 12 months. Sometimes you need to work for more than 12 months to really improve the KPIs for your entity. And who's looking at you and who's looking at your company to buy it out, they will look at historical data. They will most likely look at a minimum like 24 months, right? If not 3 years, unless you're brand new and they're buying you, from the get-go. So be proactive. If you have a thought in the back of your mind that I'm going to sell my company to get the top dollar for your company, get the right KPIs in place, take a look at that. Are you in the right tax structure to be able to sell, right? Important, because it's not the same if you're selling it as a C Corp or an S Corp. Are you a single member LLC? What is the implication, right? So let's make sure that we understand what do we need to look at. I would love to have a conversation with you. So send me a message below, and I'd love to chat with you if this is intriguing to you and this is something that you want to have a deeper conversation on.